Hello everybody, welcome to the 10th episode of me learning how to trade using Forex. So in the last video we went through day trading and risk management lessons in the beginner's lesson called strategies and risk. And now in this video we're going to be going through the rest of the strategies and risks lessons, starting with using orders to manage risk. So let's get started. Using orders to manage risk. Exit orders are a crucial part of your risk management arsenal and should always be considered as part of your overall strategy. However, it is important to note that using orders alone won't necessarily limit your losses. Rather, they have to be part of a wider plan. The chief benefit of setting orders on your own open positions is that they can help you stick to your strategy. In the heat of the moment, making the right decisions can be tricky. It is often all too tempting to let losses run or seize profits too early. A comprehensive risk management plan should outline where you are exiting each position, whether successful or unsuccessful. Your exit orders help ensure that you close each trade at your chosen level by taking the decision out of your hands. Let's take a look at some popular methods to control risk using orders. Stop orders. Stop losses are probably the most popular order type, used to limit losses and manage downside risk. I think we wrote all of this. So, systemic risk, exit strategy, position sizing, finding trades, stop orders. Three main type of risk. Oh well, we'll just write this down anyway. So. Stop orders. Stop losses are probably the most order type used to limit losses and manage downside risk. Our minds can play some nasty tricks on us when we are under pressure, particularly when money is on the line. Stop losses help you keep in line when a position is in the reds. If you enter a position without a stop order, you are opening yourself up to the psychological effects of the just one more bias. This is when you want to believe that a turnaround is on the cards and don't want to accept that on this occasion you got things wrong. True. Stop losses don't just protect you if the market suddenly reverses and you aren't able to manually close your position. They also act as an additional line of defense against the just one more thinking, automatically closing a trade if it hits your maximum loss level. Remember though that you'll need to upgrade to a guaranteed stop if you want to limit the risk of a slippage or gapping as they called it last time. Take profit orders. Being in a winning position is a fulfilling feeling when trading, but human emotion can be dangerous on the market, and that goes for positive feelings as well as negative ones. So this is, I think, to stop being greedy. For example, two issues can often plague traders who are sitting on a winning trade. One is reluctance to exit position at the right level. After all, why would you want to put an end to such a good feeling? The other is the exact opposite. Instead of letting profits run, many traders want to exit position and release them immediately, and realize them immediately. Again, the thinking behind this is clear. Until you close your trade, those profits won't hit your account, so you risk of losing them. Buy, sell limit 30 pips. A degree of greed and fear is good when trading, but when they lead to irrational thinking, it can land you in trouble. Using a take profit at your take profit. Using a take profit at your profit target can help you keep discipline, reminding you to stick to your plan instead of going off track. Used to limit. Well, it's not limiting exactly, is it? Yeah, I'll just call it used to limit profits and manage greed. Let's just call it greed. Slash fear. Trailing stops. Trailing stops Trailing stops can play a unique role in your risk management strategy by enabling you to limit downside risks while protecting profits. As we covered in the exit orders lesson, trailing stops follow your position if the market moves in your favour, but then remain in place if it moves against you. In doing so, they help limit your losses to a set number of points from the current price of your market. When opening a position, you can use a trailing stop in a similar way to a standard one. You should know your total maximum loss from a trade, so setting a trailing stop that many points away will close the position if the market immediately moves against you. However, a trailing stop may not always be the right option when it comes to controlling your risk. Your market may see significant volatility on its way to hitting your profit target, which could mean that you undercut your returns from a trade with a trailing stop. As an example, say you buy EUR/USD at a set trailing stop 15 points from its current price. Euro/dollar rises, then retraces 15 points before rallying to your profit target. Your trailing stop will close position when the market reverses 15 points. A standard stop would close the trade, allowing you to continue on your profit target. When you create your risk management plan, it is important to consider which tools you'll employ in which situations. Using stop losses, take profits, and trailing stops correctly can make a big difference to your overall bottom line.
An important lesson to learn in trading is how to manage risk. Using orders can help ensure your balance remains liquid and you don't lose more than you can afford. Let's start with the most basic, stop orders. Stop orders are the point where you make the conscious decision to cut your losses. If your trade is against you and you're losing money, you can choose a cutoff point where your position, in most cases, will automatically be closed. Once the market reaches your chosen cutoff point, your stop order becomes a market order and is filled. An important thing to remember is that placing contingent orders, like stops, may not necessarily limit your losses in the event that the market gaps through your stop level. Up next, profit targets. When you're in a profitable trade, it's easy to think that it will last forever, but that's not always the case. Profit targets can be a good way of maintaining self-discipline. They allow you to determine a profitable exit point at which to close a position before the market potentially reverses. And finally, trailing stops. A trailing stop is a stop order that is a predefined distance away from the market. They are designed to protect your gain by enabling a trade to remain open as long as the price moves in the right direction. The trailing stop will close your position if and when the price changes direction by a specified amount. Human nature is to keep going if you're winning, or to hope the market will bounce back if you are losing. Stop orders and profit targets can prevent your emotions getting in the way of potential profits, and it's good discipline to place them before or at the point of a trade. You can find out more effective ways of managing your risk on Forex.com.
Cool. So, test your knowledge. You buy the FTSE 100 stock at 6,100 with a stop loss 200 points or 20 points away and take profit 50 points away. The FTSE then rises to 6,200 without dropping. When would your stop loss or take profit execute? So you take profit 50 points away, 6100. Your stop would execute. Take profit 50 points away. Okay. You want to buy 100 Tesla CFDs at $500 and you've identified a maximum possible loss of 5,000 from. Where should you price your stop? 100 Teslas. A maximum possible loss of 5,000 from the trade. don't really know why I chose 450 here, to be honest. Yeah, I don't... This is a weird question, that is. You sell US crude oil at 4358 with a trailing stop 15 points away. Oil drops to 4341, rises to 4361, and then drops again to 432. When will your stop trigger? Drops 4361, isn't it? No, it does not. 15 stops. 4361 minus 15, that is 6. That one, is it? Yep. Okay, 6 ways to manage risk efficiently. Developing a risk management plan can seem like a daunting task, but by following these 6 steps you can get started with a strategy that suits your trading style. Determine your risk tolerance. Every trader has their own tolerance to risk. Trading instructors will often recommend risking anywhere from 1% to 5% of the total value of your account at any given opportunity. But in truth, you should decide how much you want to risk based on what makes you comfortable. Once you become more comfortable with the system you're using, you may feel the urge to increase your percentage, but be cautious not to go too high. Remember, the goal of trading is to either realize a return or maintain enough to make the next trade. If you're trading once per day on average and risking 10% of your balance on each trade, it would only theoretically take 10 straight losses to completely drain your account. On the other hand, if you were to risk 2% on each trade that you place, you would theoretically have to lose 50 consecutive trades to drain your account. Right. I see. Size each position correctly. So, 6 ways to manage. Determine risk. Size each position correctly. Once you know how much to risk on any given trade, you should be able to plan the size of your positions. Size. Getting the right balance here is important. If you're risking $100 on any given trade, then buying 100 share CFDs probably isn't a good idea. Getting the right balance here is important. If you're risking $100 on any given trade, then buying 100 shares CFDs probably isn't a good idea. If your chosen share drops by a single point, then you'll already have hit your risk tolerance for the position. One of the easiest ways to make sure you're getting as close to the amount of money that you want to risk on each trade is to learn about the contract sizes for your chosen asset classes. For example, a standard lot in currency trade is 100,000 units. On euro dollars, that represents $10 a pip. A mini lot, meanwhile, is 10,000 units. So that is 10,000... No, it's not. It's 10,000 times 10, which is 100,000. Oh, right, okay. Standard lot, 100,000 units of currency. Mini lot, 10,000 units of currency. Standard lot represents $10 a pip. A mini lot represents $1 a pip. Now say that you wanted to risk $15 per point on a year. Using standard lots, this would be impossible. Instead, you need to use mini lots. In the realm of trading, having the flexibility to risk what you want when you want could be a determining factor to your success. Having the flexibility to risk what you want when you want. Determine your timing. Unless you're planning on building or buying sophisticated trading algorithm, you'll need to be able to place trades yourself to take advantage of opportunities. Many markets are open 24 hours, which means deciding how much time you want to spend trading each day and when you want to do it. This also helps you get in the right mindset for trading, which can be useful for managing risk. Getting up at 3 AM to place a trade won't necessarily mean you're making the best decisions. Exit orders are a useful tool for managing risk where you aren't fully focused on the markets. Some traders also use alerts to notify them when their position is getting close to their maximum loss of profit target. Avoid weekend gaps. Avoid weekend. Most popular markets close their doors on Friday afternoon Eastern Time in the US. Investors pack up their things for the weekend, and charts around the world freeze as if prices remain at that level until the next time they're able to be traded. However, that frozen position doesn't show the true story. Markets are still moving throughout the weekend and may have moved drastically by the time you trade them again. As we covered in an exit orders lesson, these gaps can move the markets beyond your stop loss level. A good risk management plan should outline how you mitigate this risk. Come Friday afternoon, you'll usually have two options: close your position, upgrade your stop loss to a guaranteed stop. Watch the news. News events often have a significant impact on certain markets. Some, such as employment reports, inflation reports, or central bank decisions, can create abnormally large moves. Some will even cause a sudden gap in the market that is fully open and trading. Just as gaps over the weekend can jump over stop or targets, the same could happen in a few seconds after a major news event. So unless you are specifically looking to take a strategic risk by placing a trade around to the news event, trading after these volatile events requires careful risk management. Make it affordable. In trading, it is often said that you should never invest more than you can afford to lose. The reason is that such a widespread manifesto is that it makes sense. Trading can be risky and difficult, and putting your own livelihood at risk on the machinations of market dynamics that are varied and difficult to predict is rarely a good idea. So don't gamble away your hard-earned trading account. Invest it in a way that is intelligent and consistent. Watch the video below for a rundown on how to manage risk in your day-to-day trading.
We all like to be right, but it's not possible to be right all the time, which is why managing risk is so important in Forex trading. We've outlined 6 steps to managing risk when you trade. Firstly, work out your risk tolerance. This is the total value of your account you would be prepared to lose on each trade you make. A lower risk position, it's about 1%. A higher risk position, more like 5%. Whilst this is a personal choice, we recommend new traders start with a low risk position, taking on more risk as they gain experience. 2. Customize your position size. On the Forex.com platform, you can risk smaller amounts by trading micro and mini lots. A standard lot in a currency trade is 100,000 units of currency, which represents $10 a pip on the Euro USD. A mini lot is 10,000 units, and a micro lot is 1,000 units. 3. Manage your trading time using orders. Being available 24 hours a day to place trades isn't an option for most people, so managing your trading time is key to success. Use stop and limit orders as part of your strategy. These can automatically close your trade at a predetermined level if the market suddenly moves in an unfavorable direction, or conversely, if your profit target is hit. Please note though that placing contingent orders may not necessarily limit your losses. 4. Avoid weekend gaps. Even though the markets close at weekends, prices continue to fluctuate, which can sometimes create gaps in the market that could catch you off guard and run beyond your intended stop loss or profit target. You need to be aware of these gaps when placing your trades. You can even look at using gap trading techniques. And watch the news. News events such as employment, central bank decisions of inflation reports can create large moves in the market. This can happen suddenly, so keep your eyes open. You can follow the news feed on our website or social media channels. 6. Don't risk what you can't afford to lose. Trading is risky and difficult. Don't risk your house on a trade. By following these steps, you can help reduce your risk and increase the likelihood of long-term success. Find out more through the articles and other videos which you'll find at forex.com.
Cool. 6 ways. I think we have finished all of the beginner course. No, we have not. Introduction, how to trade. Yes, we have. Strategies and risks. Let's see. Intermediate courses. Techniques of successful traders. Yeah, let's do this. Let's work through all the courses. How to develop a trading plan. So, this is called how to develop a trading plan. A comprehensive plan is crucial to successful trading. Without one, you won't have a strategy to guide you or the means to measure your success. Why a trading plan is important. In short, the most successful traders have a plan. You can't guarantee that you'll always be able to beat the market, but a plan can help set the groundwork for successful trading. With one in place and written down, you'll find it much easier to remain focused on your trading objectives. When the markets are at their most stressful, you don't want to have to rely on your judgment. A plan tells you precisely what to do, so you can maintain discipline and consistency while keeping losses in check. Tip: a plan is useless unless it is put into action. Many make the mistake of investing a lot of time into creating strategy, but then discard it when they start trading the markets. How to build a trading plan. Evaluate yourself. To build a trading plan, you first of all need to take a step back and evaluate your market expertise, goals and weaknesses. After all, you want your plan to be tailored to you as possible. Expertise. Start by assessing your knowledge of the market, so you can ensure that you don't get out of your depth. If you're a total beginner, for example, then advanced option strategies might not be a great place to start. It is also a good idea to identify which asset classes you are most comfortable with and consider picking a handful of markets to focus on at the outset. As you grow in confidence, you can always come back and tweak your plan. Goals. Why are you trading? If the answer is just to make money, then you may not have thought this through enough. Okay, whoops. Perhaps you want to get a little extra for retirement, start a new career, or free up time to spend with friends and family. Whatever your end goal is, make sure that your plan is made with your motivation in mind. One of the best ways to do is to start at your end goal and work backwards. Consider where you want to be in 10 years and set 10 annual milestones that will get you there. Strengths and weaknesses. You'll want your trading plan to play to your strength and mitigate your weaknesses. For example, you might need to constantly watch your opening position, which can be tricky if you're holding trades overnight. You could address this weakness by sticking to day trading or using notifications and alerts to keep track of trades without always watching your monitor. You'll learn more about your strengths and weaknesses as you progress, so make sure you visit and edit your plan periodically. Choose your trading style. Now you have laid out your expertise, goals, strengths and weaknesses, you should be able to identify which style of trading suits suits you best. If you're targeting long-term returns and don't want to dedicate too much time each day to opening and closing positions, for example, position or swing trading may suit you well. Or if you're planning on trading full-time but want to avoid paying overnight funding, you could consider day trading. Want to learn more about trading styles? Start the strategy and risk course. 3. Build a strategy. Your strategy should include how you find opportunities, your risk rewards on any trade, when to trade, types of orders to use, your exit strategy. Finding opportunities. As covered in the last 2 courses, most traders will find opportunities using technical or fundamental analysis, or a mixture of the two. Now you know how each option works, weigh up your preferred method for finding new positions. Risk and rewards. Determining your risk tolerance can be tricky for anyone. A solid starting point is to consider how much you can lose in total, remembering that liquidation can and does happen if you don't maintain your full margin requirements. Successful traders may not necessarily open more winning positions than losing ones. Instead, they manage losing trades to ensure that the winning ones keep them profitable. Timing. Timing can be everything when trading, as well as ensuring that your chosen markets are open when you're planning on trading. It's a good idea to research when they might be at the most volatile. Volatility often peaks towards the beginning or end of a session, as well as when reports on news is released. At this point, you might also want to choose your chart time frames. Ideally, you don't want to switch time frames at random. Consider picking a base chart that you use first and foremost, with 2 others you can refer to when you want to confirm trends. Chart time frames. 4. Take care of the details. The final step when creating a successful trading plan is to add as much detail as possible. Lay out precisely which markets you're going to trade and when. Decide how much capital to allocate each position, as well as where to set stops and limits. A checklist can be used for reminder to use in practice. It helps to set your chosen path and reinforces why you're trading. Ideally, your checklist should cover every step when finding opportunities, opening trades and managing positions. Take care of details. And place trade. Finally, consider keeping a trading diary. Trading diary. So, this enables you to see precisely how your trading journey is progressing, so you can identify your strengths and weaknesses, eliminate mistakes, and build on successes. Your trading diary can be as detailed as you want, but at minimum, it should cover your Emotions you entered and exited position. That's an interesting one. I expected the exit one, but the entered one. Is that like excited? Maybe you're like worried? Trading diary can also help you see whether you are trading consistently. If you can ensure that you are consistent with your strategy, then you can see where it is going wrong and tweak it accordingly. 5 golden rules when developing a trading plan.
Throughout your Forex trading journey, you will have both ups and downs. It's easy to get distracted by the different trading methods out there, so you need to make sure you have a trading plan that you stick to, whatever the circumstances. Here are our 5 golden rules for building a successful trading plan. Golden rule number 1 is to keep it simple. You don't need to be a quant, creating complicated algorithms or game theory scenarios for every single trade you place. Simply find a strategy that is straightforward and easy to execute for your particular risk tolerance and trading objectives. Secondly, do your research. By watching this video, you're moving in the right direction. But the more you research the markets and news flow, the more fluent you will become in understanding what makes currencies move, increasing your chances of identifying trading opportunities. Third, be realistic with your goals. Simply stating that you want to double or triple your initial deposit is not enough. Learn to understand risk and reward per trade. Successful traders often have a profit and loss goal on entering each trade. Also, make sure you manage your risk. Work out how much risk is acceptable to you and take it from there. Ensure you're aware of the risk management tools available to you on your platform. Finally, keep a trading journal. It may seem silly, but your emotions affect your trading decisions, sometimes in a negative way. If you write down your trades, why you placed them, and the eventual outcome, you can learn from your experiences. You'll find all the research and articles you need at forex.com.
Why is it important to have a trading plan? To ensure you trade consistently, to help you stay focused, to guide you when trading stressful. All of the above. You should check your business plan before you open each position. True or false? True. What shouldn't you note down in your trading diary? The weather. Optimizing your trade entry. Getting your entries right is crucial for successful trading. In this lesson we'll cover 3 techniques to improve your timing as you enter positions. Once you have a trading plan in place, optimizing how you open positions is an excellent way of growing profits and limit losses. If you can consistently trade at the right level and in the right direction, then you should see your percentage of winnings positions grow. There are multiple different methods to optimize your entries. Here we're going to introduce you to 3. Spotting breakouts, using time frames, and taking a broader view. Breakouts. As we learned in the technical analysis course, the trend is your friend. By using pullbacks and breakouts, you can ensure that you're getting in at the beginning of uptrends and downtrends instead of at the peak. How? By using the fact that the market movement is rarely linear. Even strong uptrends will contain minor downward moves, while strong downtrends will still feature small bull runs. These small counterpart trends are called pullbacks and will tend to form at the support and resistance levels. So, what is this called? This is called optimizing trade entry. By using pullbacks, you can get these small counter trends by using the fact market movement is rarely linear. Because market movement is rarely linear, these counterparts is called to form pullback. So when it goes back down, breakouts occur when the market breaks through one of these levels. See, this is where I think having a diagram instead of writing all this word is going to be much more useful. So like something like this is going to be much more useful than just me writing a paragraph of this. But I think after I finish writing all the notes down, I'm going to like reorganize everything and just make it much nicer on the eyes and make it more easier to look at basically. So yeah. When you see a breakout, it's a sign that the original trend is reforming. When seeing a breakout, this makes them a useful place to enter a trade by opening a buy or sell position once the market moves beyond the support resistance line, making them a useful You know what, they haven't even specified what support or resistance line is. Breakout trend, the overall trend is going up, pull back, the breakouts here, entry level here, and then it goes breakout level. As a general rule of thumb, the more times the support or resistance level is tested, the stronger the breakout that follows once it is broken. As a rule of thumb, the more times the support or resistance level is tested, the stronger the breakout that follows once it is broken. Watching for fake outs. Just because a market's broken a support or resistance level, though, it doesn't necessarily mean that the breakout will follow. Sometimes the market will pull back once again into a fake out. Because of this, a proper risk management is a must when trading breakouts. By placing a stop just below the breakout level, you can automatically close position if it's a fake out. If a fake out is confirmed. Trend breakout is here. You expect it to be here, and then fake out. Put it here. Testing across time frames. as we covered in the last lesson, jumping around between lots of different chart timeframes isn't necessarily a good strategy for trading. However, by using one or two additional timeframes to confirm the trends you've found can help increase your probability of profitable trades. Using one or two. Say that using a 4-hour chart to look at opportunities in AUD USD, and you've identified a pullback that you believe might lead to a significant breakout. You could double check the broader trend by taking a look at the daily chart to confirm how long the bull or bear run has lasted. You could also see whether the market has hit any support resistance levels multiple times in its wider trend. Alternatively, you might want to check a 10-minute chart to see what's happening on a macro level, so you can check whether buyers or sellers are in charge within the current trading period. Check micro and macro. Taking a broader view. Our final tip for optimizing your entries is to make sure you're aware of the broader conditions of the market you're trading. So, be aware of the broader conditions. This includes the major mud trend that the market is in and whether that trend is sustained or just forming, as well as a few fundamental factors surrounding it. You could check whether any economic releases might cause volatility in the short term, for example. By taking a more holistic approach, you can identify potential risks to your position that you might otherwise miss. You can also outline the market conditions that suit your style of trading best. Note down the conditions for each position in your trading diary and review it often to see whether any patterns emerge. You might find that you have more successful in markets that are range bound, in swings, or experiencing low volatility, which can give you a useful boost. Manage trend. Market conditions. There are lots of different market conditions that you might want to cover in your trading diary. They can include a longer term trend, central bank posture, upcoming events, or more. Okay. I think we're going to stop here. This is a good place to stop. Yeah. So in the next video, we're going to do a risk versus reward lesson in the techniques of successful traders. Thank you for watching today's video, and I'll see you next time. Peace out.